Good evening. This is Ken Long from Tortoise Capital with a special daily market message for April 10th, 2012. We had a special day in the market today, so we're going to look at the market health check first. The regression channel, which had been formed by that regression line in the center black line, and then the channel formed by the maximum excursion from that regression line during the 30-day look-back period, got violated yesterday, and then today there was a huge violation of that channel with massive intraday selling. The channel, if it had continued normally, would be between these three black lines here. That's the extension of this other channel. I started drawing this channel yesterday based on the breakdown, the close outside of the RAF regression channel. And now if you go from the highest high, the swing high at 142, and then project those last 5 days, what you get is this tight selling channel, which would take us, if it doesn't change, down to a 10% sell-off, or the boundary of a correction in a bull market down around here. So we've got this previous normal channel, and now we've got the new normal channel. Where's the price going to go? Nobody knows. But this purple line here that I've drawn at 139, it looks to me sort of like is the boundary, the new boundary. As long as price stays below that 139, it looks more and more like this selling channel is becoming more important. And then this downward slope in the PPO, and then the jaws of MACD histogram, which warned us way back here, as we've been saying, the jaws have opened to the downside. If price stays below this 139, which I see as the boundary between these two channels, then price should stay down, and then this new channel becomes the dominant regression channel that we'll start tracking from the swing high. Now, it's important to note we just got to the edge of a 5% pullback from the swing high at 142. So 142 minus 5% gets you down here to about 135. That's really the boundary of noise. We are right on the edge of noise right now. So we get another hard day of selling, then that would start to be classified by the talking heads as a correction inside a bull market, anywhere from the 5 to 10% loss, which would get us down to 128. We would still be just within correction mode according to that interpretation. Now it gives back about 2 months worth of gains. But what's important to note here is that ADX is still strong, and even though the bears are now in charge, this previous bull market still has some legs to it, and there will be a number of people that look at this as a buy-on dip opportunity, the same people who bought on this dip here, this dip, and certainly this last dip, which was the first system shock that we had in March. And if you look at what happened after March, it went from 134 to 142. That's an 8-point move. So could it also go from 135? An 8-point move would take it right back up to the top of the swing high and test 142. What makes this one feel a little different is this is really the first massive sell day that we've had throughout this entire long run since the start of the year. So that's really what I would think of as the first system shock. If we look at that intraday, the intraday trade today was really actually pretty easy, because what you had, now we're looking at 3-minute charts, and we're looking at regression line crossover system. We see that it opened outside of the Bollinger Band channel, and then when price and their 10-period regression lines started going south, when it broke the VWAP line, we went short this morning at 79.90 with about a 40-cent stop here, and it never looked back. There was we cashed one here when the regression line crossed over, came back to the river and failed immediately, so we got short again at 79.40, and they just rode that down to 78. So on an intraday trend move, that's what a big red candle looks like when it's forming intraday, and that makes the regression line crossover system feel very easy. A day like today felt very easy on the south side, and the days that it feels easy are days when you're going to get big multiple R wins. What I want to look at now is shift over to the daily report and just kind of put this into context. So we're still in bullish normal. We're in the middle of neutral on an annual basis. We're at 2 out of 100 on the 10-day NDX. The percent stretch above the 200-day moving average is only 7.77. It's still bullish, but it went from green to white coat, so it's white bullish, a weakening bull. Same with the slope of the 50 rolled over. ADX is now down to 26. You can see the time series on the 10-day NDX has rolled over and gone into oversold conditions. A ton of signals on both overreaction and channeling, and that really says it's a market condition. That's not 15 different good signals to go long, but it really says is the whole market is now poised in this significant pullback move and waiting to look for some leadership. You can see the volatility has crept back into the market now. We're up to 1.14% ATR percentage, and so that's been a significant bump up. That's the start of potential rise in volatility after an extended quiet period. So the VIX should still be on our radar screen. We got a ton of pattern trades channeling overreactions. We've got some 5-day downs. We've got some triple screens. We have a ton that are setting up at better than 2-to-1 on the auto framer. These are the top 10 best ones. You can see with today's wide range that the distance from the pivot point at 136.67 is more than 4 points down to S3. So today's wide candle range, large candle range, makes that a pretty wide set of pivot points for tomorrow. Here you can see in the Dow Tactical, enormous number of channeling and overreaction. Really everything in the Dow, essentially. Interestingly, we had dojis in Walmart, Hewlett-Packard, and Pfizer. Those were strength leaders today. A lot of things test out at better than 2-to-1 on the auto framer. We got 1 5-day down in Pfizer. Pfizer looks to me to be interesting. It's channeling, but it was only a doji, so it was relatively strong today. It's a 5-day down and a triple screen. I really like Pfizer as a potential defensive play. So if you think money's going to move from Apple and the techs over into XLP and the consumer staples, Pfizer and Merck. Notice the big winners today: Walmart, Pfizer, Procter & Gamble, Merck. The big losers: Caterpillar, Alcoa, Bank of America. Those were formerly strong ones up here in Bank of America. So the air may be going out of the financial bubble as well. If you look at the ETFs, it's the same deal. Only silver was on a doji. Everything else is basically in a channeling and overreaction. A couple 5-day downs in coal in Latin America. Triple screen here in the NASDAQ. Max Payne was natural gas. And just about everything tests out at better than 2-to-1 on an auto framer basis. So a lot of opportunities for tomorrow. Looking at the slope of the 30-day regression line, you can see just exactly what kind of a shock it was today. This is the first decisive move of the regression line away from its 10-period moving average. You can see it's coming back to the 180-day normal. Lost almost a full standard deviation on the stretch relative to the 200. And so this, if you just were to extend the lows, this would be a natural place for it to find support if the bulls look at this as a buy-on-dip opportunity. But this is really the third, or really the fourth pullback that we've had, and it's been the biggest one by far. You had this one earlier in March, and then a couple minor ones, but you can see the steam starting to go out of the bull as we got choppy sideways. And now we've had a big sell yesterday and a long wick on the upside, and then a big sell-off day today, which puts it right on the boundary of beginning to be a correction in a bull. Let's see if there's anything else we want to look at here real quick. I would just say the 5-day loss, if we look at the 5-day holding periods, looking at the Z-scores, you see a lot of them are more than one standard deviation, so that actually represents a significant system shock today. This was more than just a drifting pullback. This was a change in market condition, a potential intermediate top having been put in, and this was the first signal that this is a potentially shocking feeling here. All the commodities starting to look better on the AlphaStat. All the U.S. Risk on trades are starting to fail now and coming back toward you get small caps and mid caps below the zero line now, and the Dow starting to roll over a little bit. and technology is coming off its high in the blue. So this, I think, this could very well be a swing back to the consumer staples of the world in the defensive play. So let's look for XLPs. The sell-off took it out of the safe zone noise channel, so that's an extra warning that this was a system shock. And that's everything I want to highlight today. These were the things that gave us system shock signals by going outside of the safe zone exits. That's spiders and diamonds, smalls and mids for the whole U.S. market, even Caterpillar, which had been very strong lately, signal to the downside. So I'd be looking pretty carefully to make sure, again, your stops are in. Take intraday opportunities when you can, and then be ready for another 5% sell-off, which would get us into the boundary of a correction and a bull. So this is very interesting. This is good for short-term traders and intraday trend traders. Frogs should do well in this environment. The standard deviations are low, and the directionality is going to get large, and ranges are going to get large. So keep your powder dry, your risk measured. Don't take on more risk than you need to, but take the opportunities when you see them. Lots of high quality setups to choose from, so stay with the ones you're comfortable with, and frame them out and get paid. So this is Ken Long from Tortoise Capital. Good trading, and we'll see you in the chat room.